Good morning, everyone. So today is our second day of this Ind AS 19 Employee Benefit Standard. So in yesterday's session, we saw the scope of this standard, what is included, what is excluded. We also saw why this standard was required. Basically, it is focusing on only one thing, that is the matching concept or the accrual concept to recognize the employee benefits. So after that, we moved on to understanding the various types of employee benefits. That is, we are having the four types. One is short-term benefits, which we have discussed already. The second one is post-employment benefits, which we are going to discuss in a short while. The third one is the other long-term employee benefits, which I hope to discuss today. And the last one is termination benefits. So in this broad category, we are having the employee benefits which are categorized. Short-term employee benefits, these are what the benefits which are payable within a period of 12 months from the reporting date. So this includes your salaries, contribution to social welfare funds, non-monetary benefits, all these paid sick leave, annual leave, all these are going to be categorized under short-term employee benefits. Entries are very simple: employee benefit expense account debit to bank, or employee benefit expense account debit to payable if it was to be paid later on. This is the entry which is passed, and then after this, we saw a special short-term benefit, that is short-term compensated absences. So compensated absences were categorized into two types: non-accumulating and accumulating. Non-accumulating means if you do not avail the leave, they will lapse, they will not be settled against extra cash. So basically here the recognition is based on the absences which get occurred. We saw it with the help of the example. If I am having accumulated paid absences, they are divided into two parts: vesting or vested and non-vesting or non-vested. So vesting means what? You are going to get cash against the unutilized leave, and non-vesting means you are going to have the option to carry forward these leaves to the next year to utilize it. So we saw that also with the help of a couple of examples. And after that, we moved on to, I've given you some homework to do. Just one of the small short-term employee benefit, that is profit sharing and bonus plans. Okay. So with this, I hope you have gone through this homework portion. Yes. Good morning, Shailesh. Good morning, Shankar. Good morning, Viraj, Shruti. Yes, feeling better. Yeah, all right. So let us start with this discussion. I'll just briefly touch upon profit sharing and bonus plans, though you have gone through it already. So profit sharing and bonus plans means where you have a present obligation to pay a particular amount of profit back to the employees, or it is a bonus. Like in India, we are having a bonus that is given in accordance with the Payment of Bonus Act. So there you are having an obligation. Now, what Ind AS 19 tells us is, it's not necessary that you only have a legal obligation. You may also have a practice of paying a bonus. Entity has a practice of paying bonus. It need not be a legal obligation, but it is what we call a constructive obligation. That means you are creating an expectation in the minds of the employees that you are going to make the bonus payment, and you don't have any other alternative but to pay the bonus. Because if you do not pay, your employees will not come to work, and if they do not come to work, obviously your office, your factory will not operate. So you have created this expectation in their mind. So what is necessary is creating a constructive obligation on the entity. If this is done, then you move on to the numbers. That means now you have an obligation to pay the bonus or obligation to pay whatever is the profit share. And basis that, you now proceed to make a reliable estimate of the amount. How am I going to make the estimate? If there is a plan, a legal obligation, follow the formula as per the plan, which is what is typically a 1 month bonus, 8.33%. which is given. If this is not there, then it could be any amount which is determined by the entity or based on probably past practice, which gives evidence of the amount. Now, management should also reflect the possibility that some employees may leave without receiving share of profits or bonus. So, for example, some companies have the habit of paying the bonus in the month of Diwali. Okay, Diwali or Dashara, whenever these festivals come, somewhere in the months of October, November, they pay the bonus. If an employee leaves the organization prior to this, then that employee will not be receiving the bonus. That is how it is. So now if that employee does not receive the bonus, what the standard tells is my reporting date is 31st March. I'm paying the bonus for the year ended 31st March in October, November. So if I have to make the provision as on 31st March, then I should also include those employees who are expected to leave without receiving the bonus. So my bonus provision should factor in any attritions that are visible in the horizon until I pay the bonus. Okay, so that is what the standard talks about. Profit sharing, a percentage of profits will be given to the employees. So that percentage is you calculate. So that is what profit sharing and bonus plans are all about. Okay. So here what they are saying, Lakshmi Mills is a profit-making entity with a reported profit of 200 crores. According to the profit sharing plan, it distributes and pays 5% to its employees if they complete 1 year within the organization. So this is the first part. Under this plan, an entity is under an obligation to pay if the employees complete a specified period. Lakshmi Mills has estimated that due to staff turnover, estimated payout would be 200 into 4.5%. Compute the liability and expense of the company under this plan. So now the question is, what rate are you going to take? Are you going to take 200 into 5% or 200 into 4.5%? The standard has given you the guidance. You will check what is the staff turnover, the attrition, and basis that you will make a provision. So my provision should be 200 into 4.5%, that is 9 crores. Do not be conservative and say we will make 10 crore provision. This is incorrect. Why? Because it is not realistic. You are giving the worst case scenario, whereas the standard wants you to give the realistic scenario. Okay, so that is why we stick to 4.5%. Okay, that takes care of this question. Okay, next one. Acer has 350 employees. I think you've done this question, but I'm just going to rush through it so that those who have not done or those who may have faced some difficulties, you are able to understand. And clarify your doubts. Okay. So Acer has 350 employees. Average staff attrition rates during the last 10 years amounts to 6% per annum. It provides the following benefits to all its employees. So annual bonus during the past 10 years. It paid the bonus to those employees who were in service during the entire financial year. Bonus was paid in the month of June following the financial year end. Amount of bonus for X1, X2 paid in June X2 represented 1,25,000 per employee. Acer used to increase the amount of bonus based on official inflation rate, which is 8.5% for X2, X3, though there was no legal obligation to increase the bonus by such an inflation rate. How would Acer recognize the liabilities and expenses for these employee benefits? Pass the journal entry. So first one, the bonus per employee is 1,25,000 or is it 1,25,000 plus 8.5%? It will obviously be the second one, that is plus 8.5%. Why? Because this is a constructive obligation. It's not a legal obligation. You pay 125, you will not be sued. But the employees have this expectation that official inflation data is 8.5%. Matlab ye baar my bonus is going to increase by 8.5%. So we stick to that. So Ind AS is realistic. It's realistic both the ways. On the positive side also, it works towards improving your profitability. On the negative side also, it is having an impact in reducing your profitability. Okay. So they are working towards a realistic model. So this gives you 135,625 multiplied by how many employees? 350 into 94%. The staff attrition rate is 6%. So 350 into 94%. So that gives you 4 crore 46 lakhs 20,625. 20,625. So this is the bonus provision we are supposed to make. Okay. So that takes care of this. So I hope that these you have understood. Then we moved on to post-employment benefits, which are categorized into defined contribution plan and defined benefit plan. Post-employment means at the time of resignation or superannuation, you are going to get this amount. You are going to get this amount. Okay. So defined contribution plan, something like provident fund, where the employer contributes to the provident fund and the employer's job is over. The employer will say, I paid to the provident fund. Now, whatever you are supposed to get at the time of retirement, don't come and ask me. You can go and ask the provident fund directly. So, depending on the growth that the provident fund generates, depending on the increase in value that it generates, depending on the rate of return that it gives, depending on the interest that is accrued by the provident fund, that much is what the employee is going to earn. So basically, the investment risk lies with the employee, not with the employer. Okay. Straightforward accounting, no actuarial assumptions, nothing, no discounting. It is a straightforward contribution of expense account debit to cash bank or payable. So that is what is a straightforward entry. On the other hand, you have something known as defined benefit plans. Benefit plans other than defined contribution plans, where the employer is obligated to pay a defined sum. Like in our example, we saw KPMG, when you retire, you are going to expect a gratuity of 3.6 crores. Now, KPMG has to give this, regardless of whether it has put the money in the PF or in X or Y or Z investments. KPMG has a liability to pay 3.6 crores when you are going to retire. And that is why you are going to have a case of defined benefit obligation. You, the employer, is liable to make the payment and you can be sued if you do not make the payment as per that plan. Okay, so that is your defined benefit plan. So your superannuating employee encashment, these are what are your superannuation benefits, which typically accrue. Okay, some companies will give a different name to it, like a long-term service recognition award. If you are there with the organization for 20-25 years and then you retire, then they will give something known as a Golden Jubilee Service Award or something after retirement. Okay, after retirement. These awards could also come during the time of retirement, during the time of employment. They will not come under post-employment benefits. They will go under other benefits. Okay. If anything happens post-employment, gratuity is the best example. Okay. That is your superannuating benefit. Okay. So that takes care of defined benefit plans, theoretical definition. Okay. Theoretical definition. Okay. So I have told you to go through these 2-3 small examples. I'll just run through them immediately. A company pays each employee a lump sum one-time benefit upon retirement. Okay. So there is a lump sum one-time benefit that is going to be paid upon retirement. The benefit is computed based on the employee's years in service and the final salary prior to retirement. So, okay. To cover its liabilities from this remuneration, the company contributes 3% of annual gross salaries to the fund. Would this obligation represent a defined contribution plan or a defined benefit plan? Think and answer, what is this going to be? There is a lump sum payment, so it could be a gratuity type of a plan. Okay, it is based on number of years served and the final salary prior to retirement. To cover its liabilities from the remuneration, the company contributes 3% of gross salaries. You remember PF, we used to contribute 12% of gross salaries. Here the company is contributing 3% of annual salaries. You tell me whether this plan is a defined contribution plan or a defined benefit plan, and why do you think so? Okay, why do you think so? Where are the others? I'm not seeing Mohammed, Tariq, Tanisha. I'm not seeing Geeta. I'm not seeing who else is there? Mansha. I'm not able to see Manoj. I'm not able to see. Where are the others? Yes. Shankar. Okay, Shankar. This I just gave you an example. Yes. Others, please tell me. Yes. What do you think of this? Do you think it is a defined contribution plan or a defined benefit plan? Okay. Yes. Okay, good. Geeta has given. Good morning, Tanisha. Good morning. Yes. Geeta. Oh, no issues. Don't worry. It's a Sunday. I'm ruining your Sundays for the entire month of December. Okay? Yeah. All right. So come on, tell me. Defined contribution or defined benefit plan? What do you guys think? I got only one answer till now, which is the right answer. What about the others? Quick, quick. Shailesh, Shankar, Viraj, Shruti, what do you think? Illustration 9. Defined benefit or defined contribution plan? Okay, Shruti has also given the answer. I'm waiting for the others. Shankar has also given the right answer. Tanisha has given the right answer. Yes. So I don't have to explain much since everybody has given the right answer. The main thing is this benefit is fixed. Fixed computation. Fixed computation. The employee knows what he's supposed to get from the employer. Employer knows what he's supposed to pay to the employee. The statute or the manner of computation, there is a defined method to do that. And therefore, it is going to be a defined benefit plan. Yeah, that's right. Sundays and winters are a deadly combination, which I am set to ruin it for you. Okay. All right. So would this obligation represent a defined benefit plan? Yes. It's not a defined contribution plan. Sir, what is this 3% contribution then? This 3% is just a cash amount which you are setting it aside. So that at the time of retirement, you are having a corpus, you are having a fund to fund this particular employee who is retiring. Sir, only 3%? Why only 3%? Are all employees will not retire at one time now. You are having maybe 2 employees, 5 employees, 10 employees who retire every day. Okay. You are having 2, 3 employees who will retire, maybe 5, maybe 10, maybe whatever, 2%, 5%. So all the three employees 3% salaries you contribute, that is just a funding mechanism. This is just a funding mechanism. You guys have come from intermediate. You had studied something known as debenture redemption reserve or debenture redemption fund. And you also studied something known as debenture redemption fund investments, where you are keeping money in investments so that when the debentures became due for redemption, you could use this money. This is similar to that. This is similar to that. Your employees retire and their obligation starts to increase. When they retire, it may be possible you may not have that much cash. I'm just setting it aside. But my liability is not the cash which I set aside. My liability is in fact the planned formula, that is the final salary prior to retirement and the number of years served. So that takes care of illustration 9. Illustration 10, in accordance with applicable legislation, company contributes 12% and employs 12% of annual gross salaries to the provident and pension fund. Upon retirement, the employees will get the accumulated balance that is calculated based on employees' years of service and his average salary for past 15 years before retirement. The pension will be paid out of the state fund assets, and the company has no further obligation except to make contributions. Would this obligation represent a defined contribution plan or a defined benefit plan? This would obviously represent a defined contribution plan. The key words which point this out is the company has no further obligation except to make the contribution. So this is a defined contribution plan. Shankar, see, superannuation plan is a plan that gives a payment to an employee at the time of retirement or leaving the organization. Okay, when he superannuates, okay, that means when he retires. It could be gratuity, it could be any agreed formula between the employer and employee. Okay, that is a superannuation plan. In very simple terms, okay, in absolutely simple terms, superannuation is when the employee superannuates. Superannuates means what? When he reaches the age of retirement. When he reaches the age of retirement, the payment that will be made under a particular plan becomes a superannuation plan. Gratuity, it is a statutory payment that is required to be made. So that gratuity becomes a superannuation plan. You won't have a separate superannuation plan that will be imposed by legislation. Gratuity is one of them. You could have other superannuation plans that each company will be having. Okay, so illustration 10 is also done. I told you to do this not immediately, these particular points for homework. You can do this later on, but just go through it. It is for your general knowledge. Multi-employer plans are discussed. Then you are having group administration plans. Then you are having risk sharing plans. And then you are having state plans, which is the provident fund. And then you have insured benefits, where you pay insurance premium and you are going to get the benefit, the coverage. Okay, so that takes care of those. Coming to accounting for defined contribution plans, obligation is determined by amounts to be contributed. We discussed this already many times. Actuarial assumptions are not required. Because there are no actuarial assumptions, there is no actuarial gain or loss. Obligations are measured on an undiscounted basis, except where they are not expected to be settled within 12 months. So entry will be employee benefit expense. If the employees are working to create a self-generated asset, then you will debit the asset. Debit prepaid expenses if you are contributing in advance, credit it to cash bank if you are paying it, or credit it to accrued liability if it is unpaid. Okay, and disclosure, you will disclose the amount recognized as an expense for defined contribution plans. In fact, in our employee benefit disclosure, we are also having employee benefits under that broad heading. We have gross salaries, and below that we are having contributions to social welfare funds like Provident Fund, ESI, Labor Welfare Fund, whatever it is. Okay. For key management personnel, also that is disclosed. Additionally, the standard requires that Ind AS 24, that for the KMT, what is it that you have contributed, you will have to disclose that separately. Okay. All right. Now, coming to the next one, we just do this 2-3 questions quickly. Okay. 2 questions are there. They are very simple questions, not complicated. Acer provides lump sum remuneration. I hope you've done this, but I'll still run it through. Provides lump sum remuneration upon retirement to its employees. Remuneration is paid out of the fund to which Acer Limited contributes 12% of annual gross salaries. Contributions are made twice a year, that is in November of the related financial year and in June after the financial year end. Total annual gross salaries for X0, X1 amounted to 50 crores. Contribution made by Acer in November was 2.8 crores. Remuneration depends on the number of employees service and amount of cash in the fund at retirement date. Acer has no further obligations except for contribution. So this is my defined contribution plan. Contribution दे दिया आजाद हो गए. Okay, I gave the contribution. I am a free man. Nobody can touch me anymore. Okay. How should this transaction appear in the financial statements? So now let us look at it. We are having 50 crores. We are having 50 crores. So my liability is 50 crores into 12%. That is 6 crores. That is 6 crores. Now, out of 6 crores, I have paid 2.8 crores. So balance to be paid is 3.2 crores, which you are basically going to accrue. So entry will be employee benefit expense account debit 6, to cash bank 2.8, to liability for a contribution 3.2 crores. Okay, so that takes care. Very simple questions. Okay, coming to question number 5. This question I want you to do it yourselves. Okay, let me tell you why. The first part, if you read, this is similar to one of the questions which we have already solved. The first part is similar to, one second, let me just share that with you. Yeah, it is similar to illustration number 4. It is similar to illustration 4. That is, this part is illustration 4, of which we have done. The company has been incurring profits. Distribute the profit. So this is a profit sharing plan, which we have already seen. You just have to put in the numbers and you are going to get the solutions. Okay. So profit sharing plans, this is similar to illustration 7. Okay. This is similar to illustration 7. Cisca has a post-employment benefit plan also available. Okay. So where contribution to the fund amounts to 100 crores, 20 has been paid. This is similar to the previous illustration 11. So basically the three illustrations put together, you have one question that has come. So please try this. You will not go wrong. I suppose this is an RTP question. Okay. I think this is an RTP question. And now we come to the key, the most important. If I have to say that the pulse of this standard or the heart of this standard, what it is, like in each of the topics, I typically discuss what is the core important thing of a particular standard. In this case, it is this particular plan, what we are going to discuss now onwards, which is the whole, it encompasses the most important part of our discussion today. Okay. So now be fully attentive. Okay. I took half an hour so that you come out of your sleep. I revised whatever I had to. I hope that revision has benefited you, gave you a quick refresher of what we did yesterday. And now coming to defined benefit plans. Sir, we discussed an example, and based on that example, let us understand what are the challenges, and we shall proceed to understand how Ind AS 19 wants us to mitigate those challenges and give a proper financial reporting methodology for defined benefit plans. Okay, so let us take the case of an employee. Yesterday I took the case with you. I am just revisiting that same case. So 1st July 2016, an employee is going to start his journey of employment. Your reporting period is 2019-20. The employee is expected to retire on 31st March 2050. That is, the service period is going to be a 34-year period. And now the problem is he is due for a particular payment on 31st March 2050. Now the payment that becomes due on 31st March 50, answer my question carefully. Is the payment which is becoming due on 31st March 2050 at the time of his expected retirement from the organization. Is it accruing on 31st March 50? First question. So, accruing on 31st March 50, or second, accruing on 1st April 16, when he joins, it's already accrued, or third one, accrues between 1st April 16 to 31st March 50. What do you think? Which option? Option 1, is the payment accruing on 31st March 50? He retires and suddenly you have a huge expense that has accrued. Or is it accruing on 1st April? The very fact he accepted, we are so honored to have this employee. We are recognizing his retirement time expense already right away. Or is it accruing as and when he performs his obligations as an employee that this expense accrues? What do you think? When is this expense accruing? When is this expense accruing? Shankar, think and answer. It's a payment that comes at the time of retirement. When is it accruing? When is it accruing? Is it accruing on 1st April? Suppose 1st April 2016 he joins, 31st March 17 he leaves. Do you pay the entire retirement benefit plan of the 34 years? Yes. That's absolutely right. Yadu is there. Yes. Okay. So Manoj is also right. It is accruing right from 1st April 16 till 31st March 2015. Thoda, it goes on increasing a little every year you have to recognize. And finally, on 31st March 2050, you are going to make the payment. That means you accrue the expenses from 1st April and it accrues till 31st March 50, and that is the liability which you are going to settle, Okay, sir. Agreed. But will I get a dream? मुझे सपना आएगा कि उसका पेमेंट कितना होगा? नहीं आएगा. You are not capable of foreseeing the future. So that is why let us take a couple of challenges which the standard has understood, which the standard knows, which the standard admits, which the standard accepts, and which the standard guides how to do the reporting. So what are my uncertainties? First one, will the employee continue for 34 years? Biggest question mark. So we talk about attrition. Okay. Next, will the employee live for 34 years? We talk about mortality. Third, will the employee be physically fit to work for 34 years? We talk about disability. Okay. So these are the key challenges that are there. Now, the payment is to be made after a huge gap of 3.5 decades. 34 years के बाद हम payment करेंगे. Right? You have to make the payment in such a large time span. After such a huge time span, if I have to book the cost today, why will I book that cost? I need to discount it to the present value. Sir, why do you need to discount to present value? Array, the payment you are making after 34 years. Do you think the company is present value? Okay. And benefit levels borne by the company plus future salary increase. See, The payment to be made at the time of retirement, the payment to be made at the time of retirement depends on the last drawn salary. How do I know what is the salary I will pay? Yes. So therefore, future salary increase is a challenge. Okay. You are going to set aside some money into some investments. That investments will give the company a return. That return is subjected to income tax. So therefore, the income tax earned by those assets, sorry, the income tax payable on the income earned by those assets is also something that you are going to factor, because that is not ultimately getting converted into cash for you. Okay. And various other estimates you are going to make. So these are all the uncertainties which we are going to see, which we are going to see, which we are going to have a look. Are we clear? Yes. Why this is particularly challenging? Yes, because I don't know many things. If I go one step further, I don't know anything. I first said I don't know many things. I modify that statement and say, I don't know anything, sir. I don't know whether the employee will be there for 34 years. I don't know whether he will be alive for 34 years. Why him? I don't know whether I will only be alive for 34 years. I don't know whether he will be physically fit to work or not, sir. I don't know what will be his future salary, sir. I don't know what income tax my will be charged on the income earned by the assets to fund that obligation, sir. Sir, what do you know? I don't know anything. I don't know anything today. The liability crystallizes on 31st March 50. Only then I will know the exact amount that needs to be paid. Before that, I don't know how much has to be paid in reality. मुझे कुछ नहीं पता. I don't know anything that needs to be done. All right. So therefore, we are going to discuss the accounting in this scenario when I don't know anything. When I don't know anything. Okay. So now coming to this particular scenario, okay. Keep this particular representation in mind. I will come back to this when I discuss certain terms. Because right now you are seeing something known as PV of defined benefit obligation, current service cost, period of service, plan assets, return on plan assets. All these right now appear to be new. These terms is okay. All right. So now look at this question. Dinkar Limited, a large IT company, accounts for gratuity on payment basis and supports the accounting policy by making the following disclosure. Due to high labor turnover, a large degree of uncertainty is involved in estimating the liability of gratuity. Accordingly, the management opines that as the estimates of the uncertainty would confuse the readers by complicating the financial statements, such a liability would be recorded on payment basis. The management opines that by making the above disclosures, the company is complying with all the requirements of the Ind AS, as a disclosure to the effect of the above is given. The management is also willing to specifically highlight the above aspect by making it conspicuous. Conspicuous means by making it visible. Okay, they will highlight it. They will probably give it red color, blue color, green color, yellow color background. कुछ भी करके they will highlight the attention of the reader of the financial statements. Okay, is the contention of management correct as per the provisions of Ind AS? Think like an auditor. Don't think like a management. Think like an auditor and tell me, is the contention of the management correct? The management, it says, I'll disclose. The management is saying, I will make it visible. The management is saying, आपको कुछ और डालना है, हम खुशी से डालेंगे. Yes, but we are not going to estimate the gratuity liability. We will account for it on payment basis. You tell me, is the contention of management correct as per the provisions of Ind AS. Tell me. Yes, Yukta, Shankar, Manoj, Shruti, Tanisha, Geeta, Shailesh, Viraj. Yadu has given the right answer. Shruti has given the right answer. Geo Paul is there. Yes. Okay, he has given something extra. That's right. See, departure from a particular Ind AS cannot be substituted or corrected or substantiated or deemed to be rectified by giving a disclosure. This is the fundamental rule that you have to understand when you go out as an auditor. When you go out after qualifying, managements of all companies will say, sir, note dal denge, sir, we'll disclose it, sir, we'll put it as a note, sir. Sir, notes and disclosures are not a remedy for not following the accounting standards. Yes, you cannot cope to that. You cannot say, I followed Ind AS 1 and I have quoted the reason for, I will put the same reason and say it is impracticable to decide what will be the gratuity amount and hence we are paying on payment basis. It's not adequate. You have to do it means you have to do it. Why are you the only organization with a high labor attrition? In your industry, nobody does a disclosure of gratuity. If that not be the case, then what is the problem with you? Yes. So a disclosure is not a remedy for not compliance. Keep that in mind. Okay. This will be very crucial, not in examination, but in the practical life out there. When your client tells us note dal denge, you have to tell them, you put a note, I will put a qualification. Okay, that is how it should work. Okay, if he does not put a note, your qualification will attract attention. If he puts a note, well, it is his choice. Your qualification continues to remain. Okay, so illustration 12 is done. All right. Now, coming to how to do the accounting. How to do the, so this particular question, the answer is the contention of the management is not correct. Okay, the contention of the management is not correct. It has to do the accounting of gratuity on an accrual basis and not just by giving a disclosure and accounting for it on payment basis. Okay, so that takes care of illustration 12. Now coming to accounting for defined benefit plans. Very, very, very important. Okay, very, very important topic. Okay, it is a four-step model. It is a four-step model. Revenue was a five-step model. Defined benefit plan is a four-step model. Follow these four steps, get the answer, and you are through in the examination. Okay. The first step is determine deficit or surplus. We'll do each of these steps in detail. आज का class इसी में जाएगा. Yes. Determine deficit or surplus. वो क्या है हम देखेंगे. Okay. Recognition in the balance sheet. Second step. Third step, recognition in the statement of profit and loss. What do I take to the P&L? And fourth step, determine the remeasurements to other comprehensive income. So four things we have to do. Now, each of these steps has further sub-steps. Okay. Further sub-steps. So like for example, determine the deficit or surplus के लिए The first step is determining the ultimate cost of benefit. Means ultimately what I have to pay, determine the cost of that. Second, you are paying it after 34 years, bring it to the present value. So discount the ultimate cost of benefit to the present value. Third, determine the fair value of plan assets. What are plan assets? Basically, money set aside to meet employee related obligations. So they are known as plan assets, and we call that as the fair value of plan assets. So fourth one, your deficit or surplus is going to be present value of obligation minus the fair value of plan assets. Okay, minus the fair value of plan assets. Are we clear with this? If it is a deficit, that means if obligation is higher, it will be a positive figure. If your plan asset value is higher, it will be a negative figure, which we call as a surplus. Then this deficit or surplus, how to report it in the balance sheet, we will discuss. How to recognize, what to recognize in the P&L, we will discuss, and what should be taken to OCI, we will discuss separately. Okay. So now coming to step number 1 in that sub-step 1. Okay. In that sub-step 1. Okay. It's kind of pictorial. So I tried to simplify it, how I can make you guys understand. Okay. Halaki, a presentation is going on since the time these patches were there. It's not a great change from what I did in the back. But yeah, this is the first time I'm taking you through the presentation mode itself. Yes. So now, computing the ultimate cost of benefit to the entity. This is the first step in step 1. This is the first initial step that you are going to do. So you have to discuss, you have to decide, you have to determine, you have to ascertain what is the ultimate cost of that benefit. Recently, the CEO of Unilever superannuated. He retired from Unilever. Sanjeev Mehta retired from Unilever. So if he retired in 2023, how much is payable to him should have been determined by Unilever years ago. Sir, वो exact नहीं होगा. तो who is asking it to be exact? In accounting, what is exact? Nothing is exact except your transactional accounting like trade receivables, trade payables. ये सब छोड़ के most of it is estimate. Leases का standard पढ़ा आपने. सर वो तो transactional है, but the discount rate. Yes, the discount rate, recognizing ROU asset, lease liability, and then doing the unwinding of the discount. Yes, that is one thing. Decommissioning restoration liabilities. Yes. Useful life of assets. Yes. Provision for bad and doubtful debts. Yes. In fact, your financial statements has a lot of estimates and comparatively lower transactional factual data. Most of it relies on management estimates. Okay. So here you are not interested to calculate the accurate cost of benefit. वो कोई नहीं कर सकता. Nobody can do it. Why? Because it has multiple variables, none of which are in your control. Yes or no? It has multiple variables, none of which are in your control. For example, you are having final salaries, you are having employee turnover and mortality. We discussed this. Investment earnings on plan assets, medical cost trends, and other variables. All these put together are variables which play a significant role, in the way in which you calculate the ultimate cost of benefit. Number 1. Number 2, high degree of uncertainty. You can't estimate the amounts as easily as it is done, say, in the case of depreciation. And third one, there is a large horizon. Okay, 30 years, 40 years, 45 years. Yes. So benefits are paid after several years with the transaction horizon extending to a few decades. So these are the three problems. These are the three problems. Okay. So now I need to minimize these uncertainties, which are of three types, and I need to account it. So my objective is accounting for the benefits as they accrue, number one, including impact of uncertainties in the amounts accounted. So both of them put together, your objective is to do the accounting. And how do I do this accounting? I have three steps to that. I have three steps, three processes to that. The first one is apply an actuarial valuation method, which I'm going to discuss now. Second one is attribute the benefits to the periods of service. And third one is make actuarial assumptions. These three steps are going to meet the first step of step one. Are we clear? Yes. Too many processes, but that is how it goes. So three steps to meet the first step in the step number one, that is determining the deficit or surplus. Okay. So now, when I talk about part A, actuarial valuation method. We also call it as projected unit credit method. Okay, it is known as PUCM in short. Projected unit credit method. Okay. So the actuarial valuation method which we are speaking about is known as the projected unit credit method, PUCM. It is also known as accrued benefit method prorated on service or benefit upon years of service method. Okay, so there are multiple names to that, but you can remember it as projected unit credit method. Okay. So what are the three variables that it talks about? So first one, it talks about the PV of defined benefit obligations. Second one, it talks about related current service cost. And third one, it talks about past service cost, if any. Okay. So we'll discuss each of these together. This is my chart. See, I am going to pay an amount at this point of time. Okay. After say 10 years, 20 years, 30 years. Is the screen visible to everybody? Yes. One of the students has a problem. Yes. On the YouTube, I'm able to see the video correctly. Okay. Is the screen visible to others? Yes, it's clear from our side, Manoj. You can just check, maybe log in again or refresh again and have a look. Okay, all right. So now you can see this. The obligation becomes due at this point, but I have to do the accounting at this point. So what the standard wants you to do is, this is a defined benefit obligation. क्या बोलते हैं इसको? Defined benefit obligation. This is a DBO. Contribution plan is left far behind. छूट गई है गाड़ी. Okay. Now we are talking about defined benefit obligation. The defined benefit obligation represents your estimate of the amount that will be paid to the employee in the future. Not looks okay. 2-3 people are saying not visible properly, sir. Just check, okay? Because I am able to see it, okay? Yeah. All right. So this is my defined benefit obligation. the amount that you expect will be paid in the future. Now that I need to discount it to the present value. Gratuity is a DBO, right? Suppose a person is expected to retire after 25 years. You will create an estimate of that. You will create an estimate of that. And when you create an estimate of that, it becomes a defined benefit obligation which is payable in the future. But आपको accounting कब करना है? When you have to do the accounting, you have to do the accounting today, now, right now. And therefore, I need to bring it to the present value. I need to bring it to the present value. And in this case, Ind AS 19 tells us, even if the obligation is due within 12 months, you need to do a discounting. You need to do a discounting. So it does not work merely on annual discounting. It works even on what you can say regular discounting, which is due within a period of 12 months also. Okay. Now, what does it give? It gives me the present value of defined benefit obligations. It gives me the present value of defined benefit obligation. ठीक है सर, हमने कर दिया उसको प्रेजेंट वैल्यू पे. The discount rate कौन सा यूज किया? Which discount rate used? We'll come to that later. We'll come to that later. But right now, I discounted and I got the present value of defined benefit obligation. Means this is the obligation which I'm going to pay, today if the employee retired today. If the employee retired today. It's the present value. It is the present value. Now, this present value should be an allocation over the periods when the employee has worked. It's not a straightforward blanket discounting which I'm going to do. It is a progressive discounting which I'm going to do because this obligation is arising on account of each year's service that is put in by the employee. Understand carefully. Okay. See. Let me explain. Now, you are having the obligation here. To do the accounting, you have to bring it to the discounted value. But it's not going to be a straightforward one-shot discounting. Why? Because each year of service, there will be some liability increase that is going to happen. There will be some liability increase that is going to happen. It's not a one-shot discounting that will be applied. Why? Because today an employee has completed 5 years. We are looking at his tenure of 34 years. So, when he performs the 6th year of service, this 6th year of service is a particular unit, This particular unit has increased the obligation. This particular unit has increased that obligation for 1 year. When he serves the 7th year, sir, तब एक और बार हम increase करेंगे. So from 6th year to 7th year, when he works, it increases the obligation by 1 more unit. So here, if I go to the last step, The 34th year when he performs, this is going to be the 34th year of service that he is there working in the organization, following which he will get the obligation. So basically, the growth in obligation arises on account of broadly two things. One is service given by employee. One is service given by employee. And the second one is the unwinding of discount. The unwinding of discount. So I have to split the DBO to the present value to account for two things. One is the service given by employee. That means here employee ने मेहनत किया है, organization के लिए पैसा कमा के दिया है. The employer has benefited from the hard work of the employee. For that, this cost will go as employee benefit expense. Whereas there is also a portion of this cost which is getting accumulated merely because the obligation is payable after a couple of years, after a couple of decades, and therefore this is a particular item that is similar to your finance cost. This is not due to the efforts of the employee, but this is due to the fact that it is on account of unwinding of a discount. It is a finance cost, but because it relates to employee benefit, this also will form a part of EBE. This also will form a part of employee benefit expenses. So each year passes by, two components are going to add the value of the DBO. One is the present value. Yes, the present value accretion that is going to happen. And second and more important one is the employee has performed service, and therefore the obligation has increased. Therefore, the obligation has increased. So coming to this, we will have to attribute the benefits to the period of service. सर कैसे attribute करेंगे? 34 years है, मुझे कुछ नहीं पता. So therefore, you don't know anything. Very good. Standard has said attributed on a straight line basis. Attributed on a straight line basis. ठीक है? So when I allocate the defined benefit obligation on a straight line basis for the expected years of service, then I am going to get, I'll explain the unwinding of discount with the help of an example. We'll do one example in detail. That time you are going to understand. Okay. But give me some time. Okay. So as of now, this is adequate for you to understand that present value to the defined benefit obligation. मतलब present value से future value तक. The purpose of this chart is when I move from present value to future value, the increase happens on account of employee service plus unwinding. As of now, if you are taking this much away from here, the purpose of this slide is met. What is discounting? Why do we do it? That we will discuss shortly. I am paying after 34 years, or in this case, I am paying after 10 years. So I bring it to the present value, and then each year I do an unwinding of that discount. Along with a current service cost. What do you mean by current service cost, sir? The employee service cost provided for that particular year. The employee service cost provided for that particular year in relation to this particular employee benefit plan. In relation to this particular employee benefit plan. Okay? So this is the first step. This is the first step. Okay. So now, how do I calculate the ultimate cost of benefit? How do I calculate the ultimate cost of benefit? Basically, the objective is to determine the present value of DBO, the related current service cost, and the past service cost wherever applicable. Okay, what is past service cost? We will see later. We will see later. Okay, so that is going to be done later. Okay, so let us understand each of these things what I discussed right now with the help of these examples. With the help of these examples. Okay, so now let us discuss. Let us discuss. Okay, a plan pays a benefit of 15,000 rupees for each year of service. Read the question carefully. You are going to understand. It's not complicated. A plan pays a benefit of 15,000 for each year of service. The benefits vest after 10 years of service. Compute the benefit to be attributed each year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. ठीक है? Okay. So for each year, 15,000 is getting the benefit. मैंने एक साल काम किया, I will get 15,000. I work for 2 years, I will get 30,000. But when am I going to get it? After 10 years. After 10 years. Okay. 10th year. This is the first year. So now the question is, from first to the 10th year, if I get 15,000, what will be the benefit attributed to each year? What will be the benefit attributed to each year? Give me the answer. It's very simple and it's visible, but I still want you to give me this answer. I still want you to give me this answer. Okay. I want you to give me the answer. What is the benefit that is attributed to each year? Yes. I need you guys to understand this and work this because it's crucial. It's crucial. If you don't understand this, you have no option but to by heart the questions, okay, which I don't want. So right now, I want you to tell me in clear terms what is the solution to each of these questions. This is the first time I'm doing these questions in a batch, okay. Normally the sessions, I had 2 sessions when I had to wind up. This time I am having a third session on Tuesday, which is giving me the extra leverage to do this. Okay. Yukta, I did not get any answer. I got only blanks. Okay, I got one answer. Yes. Yadu, fine. Geeta, fine. Manoj, fine. Shankar has answered. Yes. Shruti has answered. Yes. What about Shailesh? What about Geopal? What about Viraj? What about you guys? What is the benefit attributable? 15,000, absolutely right. Each year मैंने काम किया, 15,000 is accrued. 15,000 is accrued. The benefits vest after 10 years of service. So today I work for 1 year, 15,000 will not be paid. But is it a cost to the entity? Answer is yes. So therefore, the benefit attributable for each year of service, as you rightly said, is 15,000. Coming to the next question. A plan pays a benefit of 25,000 for each year of service, excluding service prior to 25 years. That is prior to the age of 25. The benefits vest immediately. How should the benefit be attributed to each year of service? Think about it. Think about it. Yes, all right. I'm not yet talking about any present value, Shruti. Right now, just understand the focus of this is to understand what do you mean by benefit attributable to each period of service. That's it. I don't want anything else. No present value, nothing right now. Okay. So now let us come to question 4. Let us come to question 4. What it is asking or what it is saying. So here I'm having my timeline. Here I'm having my timeline. Okay. So until the employee completes 25 years of age, nothing is attributable. After that, the plan pays a benefit of 25,000 for each year of service. Okay. So let us suppose 25 years is completed here at this stage. Okay. Before that, is the service attributable? Before that, is the benefit attributable? Answer is no. No benefit attributable. जैसे ही वो 25 years complete करता है, the moment he meets the 25 years age, we will start to allocate. We will start to attribute the benefit. Sir, how much? Sir, we will attribute 25,000 for each year of service. And the benefits vest immediately. The benefits vest immediately. Okay. So here, for each year of service, 25,000, 25,000, 25,000, 25,000, so on. Okay. Now, my question is, sir, what is the difference between this attribution and the previous one? This is illustration 4. Illustration 3, how it was? Illustration 3 spoke about 15,000 per year. 1, 2, 3, 4, 5. Okay, whatever, 10 years, वो जो भी है, 15,000 per year. Sir, what is the difference between these two? One is before 25 years, nothing was attributable. Here, nothing like that. That is factual. My point is, understand now. Answer me carefully. Forget this 25 years. इसको भूल जाओ. Okay. 25,000 attributable each year, 15,000 attributable each year. I want you to read both the questions. I want you to read both the questions and tell me, what is the difference in the manner in which these benefits are getting attributed. What is the difference? Look at the question. I'm not going to read the question. I want you to read the question and tell me what is the difference in these two. There is a very slight difference which makes a remarkable change in the treatment of these expenses in the financial statements. I want you to identify that. Hint, the second question, question number 4, that much is underlined for you. Okay, I want you to identify what is that and tell me. Okay, I want you to identify that and tell me. Okay, I want everybody to answer this for me. Okay, because if you don't answer, it means you have not understood. Okay, so please answer and tell me. Excellent, excellent. Shruti is Excellent. Shankar, excellent. Yes, I want the others to chip in. Geeta, please tell me the answer. Tanisha, please tell me. Manoj, please tell. Who else is there? Viraj, Shailesh, please tell me. What is the difference? Yes, 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 yes. In the first case, the benefits vest after 10 years of service. In the second case, the benefits vest immediately. The benefits vest immediately. Therefore, look at the way the treatment will happen. In the first question, I did not discuss this purposely because I wanted to contrast it with this question number 4. When the benefit vests after 10 years of service, it means when I am going to compute the obligation, computing the obligation requires estimation of the probability that an employee may not complete 10 years of service. Vesting का मतलब समझते हो? Vesting means from that period the employee can put a claim for that amount. From that year he can put a claim for that amount. If it is not vested, employee cannot go and demand the payment. You remember you studied Ind AS 102. In Ind AS 102, we have seen vesting period and exercise period. Yes, what is the vesting period? Vesting period could be employee has to remain in service for 3 years or employee has to meet so much of sales target. Those could be the vesting conditions. Basically, vesting period was the period when the employees start to vest in the employee, when the options start to vest in the employee. And after the vesting period is over, the exercise was possible. Similarly here, the benefits are vesting after 10 years. Matlab, I cannot do a simple 15,000 each year and attribution of benefits. Along with 15,000, I should also include probability of employee not completing 10 years of service. If he has not completed 10 years of service, do I have to make the payment of this obligation to him? Answer is no. Because उसने 10 साल complete नहीं किया है. Take a fresh chartered accountant. Tomorrow you guys are going to join Big Four industry, whatever it is. Fresh chartered accountants typically will not have a huge, time gap for, they will not invest large amounts of time for the first organization because the freshers are going to explore the areas which they like. So for a chartered accountant who is given this vesting, 15,000 per year, vesting after 10 years, the probability of that fresh chartered accountant to be in the organization for 10 years is very low. Probably it could even be 0. So therefore, I may not account for anything. But in this case, in illustration 4, the benefits vest immediately. Immediately का मतलब क्या है? What do we mean by immediately? They are vesting right now. साल खत्म हो गया, 25,000 is vested. This is something like a retention bonus. I have kept the employee with me for 1 year. I pay him 25,000 rupees salary, extra bonus. Yes. So therefore, in the 25,000, am I going to assess the probability of whether he will complete 1 year or not? Answer is no. Because जैसे ही वो 1 year complete करेगा, I will book the expense. And I have to pay it. Because employee will come and demand and say, I stayed with you for 1 year, you give me my 25,000 rupees. Can that employee do the same thing in illustration 3? Answer is no. And therefore, in illustration 3, along with attributing 15,000 to each year, I also have to assess the present value, current service cost, as well as the probability of the employee not completing 10 years of service. Are we clear between illustrations 3 and 4? Yes. Am I clear? Bolo? Yes. Tell me. Are we clear? Yes. Okay. See, each of these illustrations have very, very small lines of difference. Okay. So you have to be very, very alert with the words. If at all the institute wants to make a paper tough, they will put these small words in that. And then if you do not see these words, we will end up not answering correctly. And then we will end up with poor scores. Okay. All right. Others, please confirm. Yes. All right. For each year, Shruti, it is not month, it is year. It is year. Okay. For each year of service. He completes 1 year, 25,000 you accrue. And he can demand the payment. In the first, in question 3, you accrue 15,000, but it should be based on whether he will complete 10 years or not. Whether he will complete 10 years or not. Okay. तो पीवी नहीं आएगी यहाँ पे बिकॉज इट इज इमीडिएटली वेस्टिंग इट इज इमीडिएटली वेस्टिंग ठीक है ऑलराइट आर यू क्लियर ये ईयर वाइज है इट इज ईयर वाइज ऑलराइट इट्स वेस्टिंग इमीडिएटली ऑलराइट ठीक है नेक्स्ट नेक्स्ट लेट अस मूव ऑन टू द नेक्स्ट ऑलराइट नाउ a lump sum of 10 lakhs is payable for all employees who are in service for 10 years. Payable upon termination of employment. The plan provides no further benefit for subsequent service. Advise on attributing these benefits to the periods of service. Okay. Yes. Okay. Give me the answer. Illustration 5 for question 5. A lump sum of 10 lakhs is payable for all employees who are in service for 10 years. The plan provides no further benefit. Advice on attributing this benefit to the periods of service. कैसे करोगे? Draw this timeline that will help you. Okay. Okay. Tell me one thing. You are all soon to become chartered accountants. Yes? 10 साल वो काम करेगा. When are you going to attribute 10 lakhs? Will you attribute 10 lakhs at the 10th year? Will you attribute 10 lakhs when the person retires or resigns after 10 years? Or will you attribute it for each of the years for a period of 10 years like we did in the above cases? Samjha question? My question to you is first one. Book 10 lakhs on termination. Obviously, if it is after 10 years. Second, book 10 lakhs expense on completion of 10 years. Third one, book 1 lakh per annum for 10 years. Fourth, book 1 lakh per annum for 10 years plus the cost above should reflect probability of employee remaining in service for 10 years. What do you think? Option 1, option 2, option 3, or option 4? Which of this option is the right one? Okay, I'm getting different answers. Okay, Yukta, your answer, should it be option 3 or option 4? Think and answer. Manoj, think and answer. You also. Geopol, you also think and answer. Okay. You can just write 1, 2, 3, or 4. You need not type entirely. Okay. Yadu has given the answer. Yukta has also confirmed what she thinks. Manoj has confirmed what he thinks. Where is Geeta? Why are you not answering? Where is Shankar, my friend? Why are you not answering? Where is Mohammed today is not visible, is not answering. What about Shailesh? What about Viraj? Why are you guys quiet? What option do you think? Option 4, option 4, option 3. Okay. Yes. Now, look at the question. A lump sum of 10 lakhs is payable for all employees who are in service for 10 years. Just give me a minute, please. Okay. Yes. See, when you are answering such questions, don't be a student. Don't be a student. Look from the person. Imagine that you are the reporting head of this entity. Okay. You have, okay, so let me just make it more personalized for you. Okay. So let us assume that Geeta is the financial reporting staff of this particular company. Okay. And Yukta is joining this particular organization. So now Yukta is joining this organization means she will be getting this expense if she is there for a period of 10 years. If she is there for a period of 10 years. Now, my question is, Geeta, will she account 10 lakhs after 10 years or will she account 1 lakh each year for the service rendered by Yukta? So obviously, Geeta will rightly account for 1 lakh per year. But remember, Geeta will have a question mark. She will always have at the back of her mind a question. Will Yukta stay for a period of 10 years or no? Will she stay for 10 years or no? Yeah, I am accounting the entry. But if she leaves and goes, what do I do with this expense which I have recognized? And therefore, Geeta will estimate the probability that Yukta will leave in the future. If Yukta is not interested in the role that is being offered to her, it is not suiting her domain interests, then Yukta may probably leave after 1 or 2 years. So Geeta has to factor in this particular point. How she will factor? Well, she will look at Yukta's feedback to the HR. She will look at Yukta's feedback to her reporting manager that she's not interested. She's looking for a different role. If she's not getting that role, she will leave. Yes. So therefore, Geeta's estimate of booking these expenses will depend on Yukta's reactions to the domain that she is offered. Okay. In the books, academically, we are able to see 10 years at a stretch. मुझे फैक्ट दिया रहेगा युक्ता stayed for 10 years. Yukta did not stay for 10 years. But practically, Geeta is not able to foresee whether Yukta will stay for 10 years or not. And therefore, if I attribute blindly 1 lakh, 1 lakh, 1 lakh each year for 10 years, it means somewhere Geeta is assuming that Yukta will stay for entire 10 years. But what she has to do is, she has to ascertain the probability of whether Yukta will continue for the entire 10-year period or not. Because these expenses are vesting after they complete 10 years. After they complete 10 years. It won't be payable also after completion of 10 years. It will be payable upon termination of employment. But they are going to become, they are going to be payable or they are going to be determined based on whether they have stayed for 10 years. That is why option number 3 is not right. Option number 4 is correct because along with 1 lakh attribution, we also need to assess whether that particular employee is going to continue in this domain or not. Is going to continue in this domain or not. Are we clear with this? Yes. So therefore, your answer should reflect that probability. Your yearly expenditure should reflect the probability. A very simple instance. If there is a 20% probability she will continue, then 1 lakh into 20%. That gives you 20,000. So therefore, though the attributable expense is 1 lakh, I believe that there is only a 20% chance she will foresee. Geeta and Yukta may become very good friends when they are in the organization. And Yukta will probably confide into Geeta saying that I am not finding this role attractive. I'll be leaving at the end of this year. So when she confides, Geeta is going to get the hint that she will not be there here for 10 years. And therefore, I will factor that into my entries which I'm going to take. Are we clear with this? Yes. Because as an accountant, I have to think 10 years ahead. As a student, you know the story for 10 years. But accountant will not know ना. Accountant को 10th year के बारे में कब पता चलेगा? He will come to know the 10th year only when 10 years have passed. And if he has to pass the entry at that time, it is too late. It is too late because if Yukta stays for 10 years and Geeta passes the expense of 10 lakhs in the 10th year, Geeta will get a huge showdown from her boss because her boss will say, hasn't she worked for 10 years? Why did you not book the expense of 1 lakh each year? Because of you, my employee cost has shot through the roof. Whereas in fact, it should have been booked at 1 lakh per year. So therefore, Geeta cannot have a mind that tells her, I will book only after 10 years. No. The standard says book, but book based on the assessment of the probability. Book based on the assessment of the probability of whether the employee will stay for 10 years or not. Are we clear with this? Yukta, are we clear with this? Yes? Okay. Shruti, 10 lakhs for the bunch of employees for 10 years continued service means any employee comes, stays for 10 years, that employee will get 10 lakhs. When he will get 10 lakhs, not after 10 years, he will get 10 lakhs at the time of termination. Whether he resigns, whether he retires, he may resign after 20 years. मतलब ये 10 लाख 20 साल के बाद मिलेगा. Yes, if he retires after 12 years, he will get this 10 lakhs after 12 years. And they are given in the question that no further subsequent service benefit is going to be given. That means straightforward 10 लाख के अलावा आप रुकना चाहो आप रुको हम आपको कुछ एक्स्ट्रा नहीं देंगे. We are not going to give you anything extra. Are we clear with this illustration? Yes, sure. So this is done. Yes. Are you guys finding it interesting? Yes. Are you guys finding it a little bit interesting? Something different? Yes. See, the previous questions, we did not have so many illustrations and problems to solve. This one, we are going to have a lot of problems. How to assess the probability is the question mark. How to assess the probability? That is the challenge. That is the difficulty. And that is what makes employee benefits so complicated. You are not trained to assess the probability, my friend. You are not the one who is an expert in assessing the probability. You will probably know this based on discussions with the fellow candidate. But you can only understand high level assumptions based on inputs given by experts. Those experts are known as actuaries. Those experts are known as actuaries. You will come to the actuaries in a short while. Just wait for it. Okay, just wait for it. All right. Coming to this one. All right. Question 6. A plan pays a lump sum benefit of 15 lakhs that vests after 12 years of service. The plan provides no further benefit for subsequent service. Attribute the benefit to each year of service. Is it similar to question 5 or not? Is it similar to question 5 or not? Is it similar to question 5? I'll give a break. I'll give a break. Just give me some time. Why it is not similar? Where it is not similar? They have not given one thing when it is payable. Okay. Like, see, this particular set of words, payable upon termination of employment, these words are not there here. But वो तो payment है. That is just settlement of a liability. See, Ind AS 19 largely focuses on P&L में कितना जाएगा. What is it that hits the profit and loss? That is what this standard is all about. Though we have certain clauses which tell us that expenses should go to the respective asset account wherever they are used for constructing an asset, blah, blah, blah. The standard's core intent is भाई मेरा एम्प्लॉय कॉस्ट P&L में कितना हिट करेगा. द पेमेंट ऑफ द ऑब्लिगेशन इज अ लायबिलिटी सेटलमेंट. वो तो बैलेंस शीट टू बैलेंस शीट मूवमेंट इट इज. बट बुकिंग द एक्सपेंस hitting the profit and loss account, वो कितना है, that is interesting. That is what the standard is all about. Now, in this particular case, question 6 is quite similar to question 5. Sir, how? Question 5 क्या था? A lump sum of 10 lakhs is payable for all employees who are in service for 10 years. यहां पे क्या है? 15 lakhs vesting after 12 years. अरे दोनों में लैंग्वेज का फर्क के अलावा कुछ भी नहीं है. 10 lakhs for those who are in service for 10 years means this 10 lakhs has a vesting period of 10 years. In the second case, 15 lakhs has a vesting period of 12 years of service. Only language is different. The intent is the same. The meaning is the same. Only my figures have changed, my friends. Be very, very alert when you are reading the question. 15 lakhs divided by 12, I will attribute 1.25 lakhs per annum. But is this a straightforward attribution? Answer is no, because the vesting happens after 12 years. Same question. Yukta has joined Geeta's office. Geeta is the financial reporting head. She knows that payment has to be made to Yukta for 15 lakhs if she is there for 12 years. Each year now onwards, Geeta has to start attributing 1.25 lakh. But she will have at the back of her mind, will Yukta continue for 12 years? She does not know. So therefore, she has to assess the probability. She has to determine the probability. So if I have to attribute the benefit to each year of service, it will be 1,25,000 per annum, 1,25,000 rupees per annum, along with what? Along with a probability of whether the employee will complete 12 years of service or not. That's it. It's exactly the same as 6. 6 and 5 are similar, except for the fact that there is a small change in words and nothing else. And nothing else. Are we clear? Yes, are we clear? Yes. Are we clear, everyone? Did you guys understand? Yes? Okay. Let us move on to the next one. Okay. Acer Limited provides the following benefits to its employees. A lump sum of 30 lakhs for all employees who are in service for 20 years at the age of 50. Or for all employees who are in service at the age of 60, regardless of the length of service. That is, if they are not fulfilling the first condition at the age of 50. Second benefit is amount of 2 lakhs for each year of service payable upon termination of employment. This benefit becomes vested after 5 years of service. Advise Aether Limited on attributing these benefits to the periods of service. Think and answer. Think and answer. Okay. It is yes, Geocall, that's right. The treatment of expenses is exactly the same. In the first case, it was 1 lakh per annum for 10 years, subject to the fact that you have to assess the probability whether the employee will continue for 10 years. Illustrate question 6, 1.25 lakh per annum for 12 years, subject to the fact that you have to assess whether the employee will continue employment for a period of 12 years. That's it. Only the figures have changed. The question remains the same. Okay? All right. Question 7. You will have to draw a timeline for this question. 7A is not simple. 7A is a little tricky. Okay? ज़्यादा difficult नहीं है. But if you draw a timeline, only then you are going to understand. Only then you are going to understand. Okay? Yadu, I am waiting for your answer on this one. Shankar, Tanisha is not answering. Where is she? I want your answer. Okay? अभी चेक कीजिए. हाँ, हो गया ना. Okay, all right. Sorry guys, there was a network issue. Thanks for being there until then. Yes, we had some technical issues, but it's fine now. Okay, all right. So coming to question 7, Acer provides the following benefits to its employees. A lump sum of 30 lakhs for all employees who are in service for 20 years at the age of 50. So at 50, if they have completed 20 years, that means they should have joined when they are of 30 years of age. When they are of 30 years. Next, what else is there? For all other employees who are in service at the age of 60, regardless of the length of service, if you are not fulfilling the first condition at the age of 50. So if that be the case, if that be the case, how shall we attribute the cost? How shall we attribute the cost to each year of service? That is the question mark. Okay. So for employees who join before 30, so those employees who join before they are 30 years, they will complete 50 years. They will complete 50 years, right? See, they are saying either 20 years of age, either 20 years at the age of 50, or for all employees at the age of 60, we will make the payment. Okay, we will make the payment. So we will look at the first case. First case. Employees completed 20 years at age of 50. That is joined at 30 years or before. So that means they have served here for a tenure of at least 20 years. At least 20 years. So the entity has decided for those who have served 20 years at the age of 50, we are going to give them this benefit. We are going to give them this benefit. What is the benefit? 30 lakhs for all employees. Okay, who have completed 20 years. So you complete 20 years at 50. So therefore, benefits to be attributed per month is equal to rupees 30 lakhs divided by 20 years is equal to rupees 1.5 lakhs per annum is equal to rupees 1.5 lakhs per annum. Of course, like how we discussed the previous one, here also we will have to assess. We will have to assess, right? That they are completing the age of. We will have to. No, we don't have to. Yeah, assess whether employee completes 50 years of age and continues to remain in employment. Fair enough. Are you able to understand the first case? Are you able to understand the first condition? Yes or no? Are we able to understand the first condition? Yes or no? Boys, girls? Understood? Okay, fine. Now we come to the next set of employees. These are the employees who have completed 60 years and they are in service. These are the employees who have completed 60 years. They don't have a 20-year service requirement gap. From the time they join till 60 years, if they have completed, then they will be eligible for getting the payment. So therefore, employees age 60 still in service. Therefore, benefits to be attributed per annum. This should be per annum. My bad. Okay. Benefits to be attributed per annum is equal to 30 lakhs divided by. Now they are in service at 60 years. 20 years का criteria नहीं है. From whenever they are joining. From whenever they are joining. So 60 years minus age when employment started. So that is equal to whatever figure comes. We don't know. Whatever figure comes, we are not aware of. Okay, it will come to some figure. So that will be again the yearly cost. The yearly cost. But this will be assessed whether employees remain in service at 60 years. And this is a very specific class of employees. This is a very specific class of employees. What is the specific class of employees? Joined after 30 years of age. Because if they joined before 30 or at 30, they would complete 20 years at 50 and they would be eligible at the age of 50 years only. But in this case, if they become eligible at 60, then they would have joined after 30. They cannot join before 30 because before 30 means by 50 they would have completed 20 years. So, and when they were 50 years only, they would be getting the benefits. But now they are not getting the benefits. Then they are getting the benefits at 60. That means they must have joined after they are 30 years of age. Are we clear? Yes. Sir, if they have completed 20 years service but not aged 50 years, no. They have told now, see, lump sum of 30 lakhs for all employees who are in service for 20 years at the age of 50. So 50 hona jaruri hai. It is necessary for you to be 50. It is necessary for you to be 50. Are we clear with this? Yes. Are we clear? Slightly confusing, but it is not so confusing if you read it, if you break it down and read it correctly. Okay? Yes. Muhammad, finally you are there. Okay? Yadu, did you understand? Shankar, did you understand? Your answer was mostly right. Okay? In both the cases, the first part was right, the second part of 60 was not right. Okay? So that is now sorted out. Yes, all right. Geeta is there. So Tanisha is there. Shailesh is there. Shankar. These people, I think we had some issue with the network in between. Okay. All right, it's clear. Great. So that takes care of the first part. Second part, 2 lakhs for each year of service payable upon termination of employment. The benefit gets vested after 5 years. So your cost will be 2 lakhs for each year for the first 5 years, assessing the probability of whether the employee will remain in service for 5 years or not. And if yes, then accordingly you will take the amounts each year. Take the amounts each year. Okay? Are we clear? Yes. So that takes care of question number 7 as well. That takes care of question number 7 as well. Okay. All right. I leave you with homework for these two questions. Okay. Try to solve them. It's not difficult. It's simple. Tuesday, if you don't understand this, we are going to have a look at it. Okay. But try to do these two questions because they are based on similar concepts to what we have studied. Okay. And now we'll take a break for about 10 minutes. It's 9:24. You want a break? We had a long break in between. But do you guys want a break or do I continue without the break? What do you want? Yes? Continue? Okay, fine. So let us continue. See, the questions that we now do will form the basis of understanding. The questions that we now do will form the basis for understanding the entire standard, particularly defined benefit obligations. So let us try to work out how this concept of ultimate cost of benefit ultimately works. Okay. So now question number 9. This is not there in your study module. This is just a presentation of how the questions will have to be solved going ahead. Okay. Acer Limited hired a professional in April 2017 for 6 years of service, which would terminate in March 2023. Apart from regular salary and annual bonus, Acer Limited will pay a lump sum remuneration of 45 lakhs to her upon termination of employment. Discount rate used for actuarial valuations is 10% per annum. Show how the obligation builds up over the employee's service. Ignore actuarial assumptions other than the given discount. Okay. So now let us understand. She is going to get 45 lakhs upon termination of employment. 45 lakhs divided by 6 years means what? 45 divided by 6, we are going to get 7,50,000 rupees per annum. We are going to get 7,50,000 rupees per annum. So therefore, let me just give that presentation to you. I showed you. Okay. Okay. You can do it horizontally, you can do it vertically. Okay, anyhow is fine. But she joined in 2017. This is the first step. Attributing benefit to periods of service. Okay. So here I am having 6 years, 17, 18, 18, 19, 19, 20, 20, 21, 21, 22, and 22, 23. Okay, so these are the 6 years. Now, opening balance, current year, that is 45 lakhs divided by 6 years total. So each year is going to be 7 lakh 50, 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 7 lakh 50. So first year opening is 0 plus 7 lakh 50. Opening is 7 lakh 50 for the second year, 15 lakhs. $2,250, 30, 3750, 45. Okay, so this takes care of the total attributing the benefits, first one. Now, second one is measurement. Okay, so how do I measure this? How do I measure this? Is it done so far? Yeah. So how do I measure it? Okay. Now understand opening obligation. Discounting factor at 10%. Okay. So now, see, the payment is going to happen after a horizon of 6 years, right? So today I have to start accumulating the cost. Today onwards, I have to start accumulating the cost. I am given a discounting factor of 10%. I am given a discounting factor of 10%. Now the question is, how do I do the discounting and at what value should I start recognizing my obligation? So first year opening obligation is 0. And because opening obligation is 0, interest thereon also will be 0. Interest thereon also will be 0. Coming to discounting factors. Now, 7,50,000 per annum is the value of the obligation that you are going to pay at the end of 2022-23. At the end of 2022-23, that means on 31st March 2023, you are going to pay them 7,50,000. Yes, that means within on the same day, on 31st March 23 itself, the payment will happen. So what will be the discounting factor? The obligation value is 7,50,000. Hey, this is uploaded. Yukta, this is uploaded. I'll tell you. I have uploaded on the assignment section. Okay. I have uploaded on the assignment section. Please have a look. Okay. I'll show you. This one. There will be one more. Yeah, this sheet is uploaded for all of you. All right. The handwritten note is exactly what I am doing based on this. So this is already uploaded on the assignment column. You can have a look at it. Okay. But I solve it because I believe when I solve it, you are able to understand better. Just giving these notes is not going to help you. Okay. So now let us come back. So understand now how the discounting. It's not a normal discounting, it is a reverse discounting. 2022-23, the obligation was 7,50,000. And when am I going to settle this obligation? Sir, on the very same day when it arose, that is on 2022-23 itself. And when it is arising on that day. So the discounting factor for that day is going to be 1, is going to be 1.0000. Is it okay? Because the same day I'm going to do the payment. The same day I'm going to do the payment. So that is why it will be 1.0000. Are we clear with this? Yes, are we clear with this? Anybody has any doubts? Anybody has any doubts? Please let me know. Okay. Let us then move on to the next one. Let us move on to the next one. Obligation of 21-22. Obligation of 21-22. I am going to settle it at 31st March 2023. 1 year later. 1 year later. So therefore, the discounting rate applicable here will be 1 divided by 1.0 raised to 1. That will be 0.9091. 0.9091. Okay. Now the next one is 2020-21. 2020-21. Obligation of 21 will be paid in 2023. That means 2 years later. So 1 divided by 1.10 raised to 2. 1.10 raised to 2. Okay. So that comes to how much? That is going to come to 0.8264. Are we able to understand how the discounting is working? Yes, because then it will be just a multiplication and determining the present value. But you should understand how the discounting is happening. Yes. 2019-20, 31st March 20, the obligation is going to be paid in 2023. That means 21, 22, 23. That means after a tenure of 3 years. So 1 divided by 1.10 raised to 3. 1 divided by 1.10 raised to 3. So that comes to 0.7513. 0.7513. Anybody has any doubts? Yes. Same you go here, 1 divided by 1.10 raised to 4. So that comes to 0.6830. 6830. And then the last discounting will be for a tenure of 5 years. 1 divided by 1.10 raised to 5. Yes, but I am not discounting 45 lakhs. I will be discounting 7,50,000 of each year because the obligation is accruing on an annual basis. The obligation is not suddenly accruing 45 lakhs. The obligation accrues as 7,50,000 year 1, 7,50,000 year 2, 7,50,000 year 3, year 4 and year 5. So therefore, I am going to accrue it individually. Discount also is going to be applied only on a progressive basis. It's not on entire 40 lakhs to the present value and then you increase it. Okay. That is not what it is getting us into. Are we clear? Yes. So this comes to how much? 0.6209. 0.6209. Okay. So my current service cost is going to be 7,50,000 into 0.6209. 7,50,000, this one into 0.6209. So that gives you how much? 460. Without rounding off, if you take, it will come to 4,65,691. So closing obligations. What will be my closing obligations? ₹4,65,691. Shruti, 45 lakh is not year-wise obligation. Na? 45 lakh is a 6-year obligation. It's not year-wise obligation. आपका total should build up na, slowly. It should build up and factor in the finance cost that we are now calculating. You would remember you had asked me a question of what is that finance cost? That is now going to come here. So 4,65,000 is the value. 4,65,691 is the value of the first year. So opening obligation is 465,691. So at the rate of 10%, 46,569. 569. 5,12,260. Current service cost, which is nothing but 7,50,000 into 0.6830. 7,50,000 into 0.6830. So the total comes to how much? So the total comes to 465,691 plus 46,569 plus 5,12,260. So that comes to 10,24,520. 10,24,520. 10,24,520. 102,452. So now 7,50,000 into 0.7513. So that comes to 486. And then let us move this 563, 486. Okay. 7,50,000 into 0.8264. So that comes to how much? 835. So the total value of the obligation 563 plus 6,19,000. Yes. Yes. Sorry. My bad. This total will be 16, 19, 458. One 69046 and 6,19,855. Yes. So that comes to 16 plus 169 plus 6 lakhs. So that comes to how much? 79,339. Shruti, I'll come to your doubt. Okay, I'll come to your doubt. Yes. Current service cost 7,50,09091. So that comes to 681,818. So that gives us how much? That gives us 34,09,091. Nine zero nine. Seven lakh 50. 45 lakhs. So ultimately, the obligation gets built up to 45 lakhs. Now the question is, why do we do a reverse discounting? Why not a regular discounting? That is the question that I have received, and one which I have already answered, but I am again answering. Right? Why am I doing it? And then we are having another question. Why at year 6 the discounting factor is 1? Why not in year 1? Okay. See, the service is provided by the employee in year 1. When am I going to make the payment to him? Am I making the payment in year 1 or am I making the payment in year 6? Sir, we are making the payment at the end of year 6, not at the end of year 1. So year 1 the employee works. उसका पेमेंट उसको कब मिलेगा? 5 साल के बाद. He will get the payment of that after 5 years. Today he will render the service, you will book the obligation, but the payment will come after a period of 5 years. The payment will come after a period of 5 years. And therefore, year 1's discounting factor cannot be 1. It has to be discounted by 10% for 5 years. It has to be discounted at 10% for 5 years. But, let us move further. Suppose year 6, that employee continues. In year 6, that employee completes her obligations in year 6. That means as on 30th, that means as on the 30th day of the 6th month, he is a free man. So therefore, at that point of time, when you are having, what you can say, when you are having an obligation that has to be paid on the same day when it is provided, the discounting factor is going to be 1.0000. Are we clear with this? Yes. We cannot use year 1 discounting factor as 1 because the changes are that year one's obligation is not realized, is not paid in year one, it is paid in year six. So therefore, a time span of 5 years. Year two's obligation is not paid in year two, it is paid in year six. So therefore, you are having a 4 year a 4 year gap. Year three's obligations are paid in year six. Year four in year six. Year five in year six. Year six is paid in year six, and therefore those items are not having any discounting obligation that needs to be done. Year six, you do the obligation and immediately you settle. Immediately you settle. And therefore, year six, no discounting, direct bill. Are we clear with this? No discounting, direct recording of the expense. Are we clear? Yes. Anybody has any doubts here so far? Anybody has any doubts of how the obligation got built up? Yukta, you followed why there is a discounting factor of years. Yes. Why the first payment does not have one? I hope that is clear. Shruti, why are we doing backward calculation? I hope that is also clear. Yes or no? Shruti, did you follow the backward calculation why we are doing? Yes. Yes. All right. Good. So if you come to our question, this 7,50,000 is the unit cost. Is the unit cost. Okay. Unit of benefit. Current service cost. Current service cost. Okay. So interest cost at 10% is so much. And that gives you the closing obligation. That gives you the closing obligation. Are we clear with this? Yes. All right. So now I want us to take a break. We take an 8-minute break. We resume at 10. I'll try to cover up some more within half an hour, 1 hour, and try to finish the defined benefit plan so that you are able to understand. Okay. We take a 10-minute break and resume at 10, please. Okay. Yeah. Okay, all right, guys. So let us continue. Shailesh, you did not get the same answer with 7.5 lakhs into present value. Which same answer are you talking about? See, each year I am not multiplying 7 lakh 50 with that respective. When I unwind the discount, I am not multiplying 7 lakh 50 with 10%. I am multiplying the opening obligation value. I am multiplying the opening obligation value. That is why you are not going to get that particular amount. Okay, these amounts, what you are going to see, these amounts 1, 2, 3, 4, 5, 6. These amounts are not going to be the total of the obligation because there is an interest unwinding component that is happening here. So therefore, merely by taking your calculator and doing it as 1 plus 0.9091 plus 0.8264 plus 0.7513 plus 0.6830 plus 0.6209 into 7,50,000 is not going to give you any meaningful answer. Is not going to give you any meaningful answer. Is it okay? Yeah. So therefore, that part you cannot do it that way. It's not an annuity factor what we are calculating. Okay. Yeah. So that won't come. Annuity won't come because each year we are unwinding the discount which we had already recognized. So there are two things which are happening here. One is the discounting factor we are adding it, and second is the interest component we are unwinding it. So that is why it won't be the same. Okay. So since the payment is done after 6 years, the discounting is done backwards. That's right. If the payment is done today, why are you going to discount it, my friend? You will straight away take the current value as the future value. That's it. Which is what is happening in year 7. Which is what is happening in year 6. Sorry. Year 6, same. Alright. So that takes care of this question. Anybody has any doubts here? Girls, any doubt? Any doubt? Yukta, Ruti, are you guys having any doubts? Tanisha has left, I suppose. Okay. Shall we proceed further? Okay. All right. So now we have discussed two things. If you recollect what we were talking about, we first spoke about the actuarial valuation method. That is nothing but the projected unit credit method. We did those 3-4 examples where we saw how to attribute the service cost to each year of service. That is the first one, the actuarial valuation method. The second one, what we saw was attributing benefits to the period of service, which we have done. And the third one is actuarial assumptions. Now, what do you mean by actuarial assumptions? Actuarial assumptions can be classified into two broad categories. One is your demographic assumptions, the other are your financial assumptions. What do you mean by demographic assumptions? Assumptions which relate to the future and current features of your employees. Like, for example, mortality rates, rates of employee turnover, proportion of plan members with dependents eligible for benefits, proportion of plan members who will select each form of payment option available under the plan terms, claim rates under medical plans. All these become your demographic assumptions. Sir, ये तो बहुत ही personal details है ना? These are very personal details. How will I capture this? You remember HR form आप fill करते हो. In that HR form, you write your name. Okay. Married. Of course, many of you may not be married as of now. So you would be single. But in case you are, you would write married. So then they will ask children, dependents, parents. All this data will come. Then they will ask you for your health profile. You will undergo a medical test. If you are beyond a particular age or in a senior management, gadi you have to go and undergo a medical test every year. Okay, they take your readings. Those readings are submitted to the HR department. They will ask for family history of diseases. Why do they take all this? Do they take all this because they just want to know inside outside of you? That is one side. But apart from that, this data which they collect, the HR collects from you, which the HR has of you, the dependence data which the HR has, all this data is required only for the purpose of determining the employee benefit also. Okay, so the accounts team will have this data coming in from the HR, will have this data coming in from the HR, rightly so. Are we clear with this? Yes. So these are my demographic assumptions. Assumptions that relate to the profile of a person. Assumptions that relate to the personal characteristics of an individual. All of these are collected by the HR department in the form that you fill while joining employment, and that is made available to you. That is made available to you. Financial assumptions. What do you mean by financial assumptions? Discount rates, future salaries, benefit levels, future medical costs, taxes payable by the plan, everything relating to numbers which you and I are familiar with. Together, these assumptions, demographic plus financial, they make it a part of the actuarial assumptions. They make it a part of the actuarial assumptions. Can these actuarial assumptions change over time? Today, I have joined. Suppose you have taken an assumption that the employee will not die till he completes the employment. Now, can this change in the future? Answer is yes, it can. Mortality levels can change. Suppose you are in the habit of what you can say, you have a family history of heart disease. This was not known initially, but later on, after you completed 7-8 years, this came to be known. And then your symptoms also started increasing with that. So probably those mortality levels, what you assumed initially, will no longer work. That will undergo a change. So therefore, can actuarial assumptions change? Answer is yes. Because of actuarial assumptions change, because of change in actuarial assumptions, there will be an impact on my obligation. See, I did a straightforward question where I thought this person will be alive for 6 years and I will do the payment. But when I told you Geeta and Yukta working for the same office, Geeta assumes that she will continue in the office for the next 10 years or for the next 12 years. So that would be based on certain assumptions, certain actuarial assumptions. Now, if those actuarial assumptions change, will Yukta consider working here? Like, just for a simple example, okay, don't take it very personally, but suppose Yukta gets married and settles in the same city in which this particular office is situated, and this is a very good organization for her growth. So Geeta previously estimated she will not continue. But because of this demographic development in her life, do you think their assessment of probability of whether she will continue or not will change? Answer is yes. It may undergo a change. And because it undergoes a change, will it make a change in the calculation of obligation? Answer is yes. Previously, she probably estimated a 20% chance she may continue. Now she has her family set up here, so the likelihood of her continuing is 100%. You can assume it is 100%. So therefore, if that is what it is, then the obligation what you have to estimate will increase. Now this increase is on account of factors which are not in control of the organization. They are increases on account of change in actuarial assumptions. That means her demographic profile changed. When she joined, she was single. But as the time progressed, she started a family. And because of that, her priorities have changed. Because her priorities have changed, the company impact on the obligations payable to Yukta has changed. And this impact is on account of change in actuarial assumption. And therefore, this impact will not hit the profit and loss account. It is going to hit the other comprehensive income because this is due to change in actuarial assumptions. Now, sir, how will I come to know what will be the actuarial assumptions? वो आपका काम नहीं है. That is not your work. That will be the work of trained professionals known as actuaries. You are aware of actuaries, I suppose. AC, you are aware of these people. Okay. You should be aware of these people. Actuaries. Okay. Actuaries. Who is an actuary? An actuary is a professional who is skilled in assessing probabilities, in statistics, who is skilled in determining the premium that the insurance companies have to collect from the policy holders, how much premium to be charged. All of this is going to be going to be calculated by the actuaries. And after the actuaries calculated, it is then published as the standard premium which people have to pay for the policies that they take. It is these people who give these assumptions. Financial assumptions, demographic assumptions, change in assumptions. What is the impact on account of change in actuarial assumptions? All these workings are given by the actuaries themselves. Your job for the purposes of financial reporting is just to take the correct impact of those assumptions. Is just to take the correct impact of those assumptions. Of course, you have the freedom to question the actuary. You have the freedom to question the actuary. Sir, why do you believe that so many employees will not resign when the data that we have is contrary? So you can definitely question the actuarial assumptions so that you arrive at what are kind of true actuarial assumptions. And accordingly, you can do the financial reporting. Are we clear with this? Yes. Have we understood what are actuarial assumptions? Yes. Have we understood what are actuarial assumptions? Yes. Is it clear? No doubts? Okay. So just go through this. This is theory. Okay. You can just go through this. I don't have much to solve in that. Okay. Nothing much. So let us proceed to the next one. Okay, now let us talk about past service cost. Let us talk about past service cost. You remember we had done one question where seventh pay commission led to an increase in the liability of 240 crores, and when you have to recognize it. Do you remember that question? Yes. Do you remember that question? Do you remember? Yes, I hope you remember that question. because that is an example of a past service cost. That is an example of a past service cost. There is a change in the present value of the obligation for employee service in prior periods. There is a change. That change could be due to a plan amendment, or it could be due to a plan curtailment. It could be due to a plan curtailment. Yes. So let us try to see how does this past service cost work with the help of a numerical example. With the help of a numerical example. Then you are able to understand it better. Okay. All right. Okay. Now, this question is there in the study material in this slide. This question is there. Okay. This is the question. Question 10. Okay. If I start writing it, I will end up spending another half an hour, 45 minutes. I want to discuss more and more concepts with you so that you are able to get a lot today, because on Tuesday, it is office for everybody, including me. So therefore, I will be doing more simpler things on Tuesday. Today, allow me to do complicated things. Okay. And in an easy manner. Okay. So now, let us look at the question. Ratna Limited pays a lump sum benefit on termination of service equal to 1% of final salary for each year of service. Okay. The salary in year 1 is 1 lakh. 1 lakh or 1 crore? Okay, 1 crore. Sorry, 1 crore, which is assumed to increase at 7% per year. Fine. Assumed to increase at 7% per year. The discount rate used is 10% per annum. Show the buildup of the obligation in respect of an employee who is expected to leave at the end of year 5. Ignore all actuarial assumptions other than the given discount rate. Later on, second part, Ratna Limited wishes to revise the percentage of the benefit from 1% to 2.5%. Discuss the impact of this change if the benefit was revised at the end of year 2, if the benefit was revised at the end of year 5. So we will first do the part 1. That means straight away calculating the benefits. So salary in year 1 is 1 crore. Salary assumed at the end of year 5 is 1 crore into 1.07. This is second year salary. This is third year salary. This is fourth year salary. This is fifth year salary. Many students will make a mistake. They will write 1 crore into 1.07 5 times. You should write 4 times, because first year is 1 crore. Second year is 7% increase. Third year is 7% increase. Fourth year is 7% increase. Fifth year is 7% increase. That means 7% increase happens only 4 times and not 5. So here many students end up making the silly mistake. Okay, but it is a costly one at time. All right. So the salary comes to be 1 crore 31 lakh 7,960. And the benefit cost is how much? 1.31 crore into 1% into 5 years. So that comes to 6,55,398 rupees. So if I have to allocate it for the periods of service, then see, this is for a period of 5 years, right? Pays a lump sum benefit who wishes to leave at the end of 5 years. So therefore, it is for a 5-year tenure. So therefore, 6,55,398 divided by 5. Each year 131,080. Each year 1,31,080 rupees is going to be the what you can say, the obligation value. This is not the present value. This is the obligation value. Now I have to discount it. End of year 5, 1,31,000 will be charged, 1,31,000 will be paid, discounting factor is 1. End of year 2, 1,31,000 will be paid at the end of year 5, but we are going to record it at the end of year 4. So that 1 year is the gap. So that will be the discounting for year 1. Moving on to the next one. Year 3 liability will be paid in year 6. So therefore, you are going to have will be paid in year 5, sorry, not in year 6. So therefore, a 2-year discounting, and that is going to give you your current service cost. End of year 2 versus end of year 5, 3 years. And finally, current year versus what you can say, current year obligation, end of year 1 will be paid at end of year 5. So 4 years discount. 4 years discount. So that gives you the present value of benefit attributed to the current year, which becomes my current service cost. Which becomes my current service cost. Are we clear with this? Yes. Are we clear? Are yes or no? So far, is it clear? So far, is it clear? Please confirm, everyone. Jigar is there today. Shruti, have you understood till now? Okay. Everybody has confirmed. Yes. Now, what is the entry that I will pass? Employee benefits expense account debit for these amounts. Interest, which is essentially going to go under employee benefits because this is not the loan. Okay, this is like a notional entry which we are taking. Okay, so now this one is going to go and hit the P&L. This interest at 10%. This amount. Okay. It does not sit below EBITDA. It goes and sits as employee cost because it forms a part of the employee cost only. It's not a loan. It's a notional entry. So therefore, they take it in the employee benefits only in the P&L. Okay. So that is done. That concludes the original accounting. That concludes the original accounting. Now, what they want to do? Now, what they want to do is they want to change the percentage of benefit from 1% to 2.5%. Okay? Is this an actuarial assumption? See, whenever I ask, is it an actuarial assumption, you have to answer only one thing. Is it within my control or is it within the entity's control or not within the entity's control? Then you can answer this question better. So now, the fact that they are increasing the percentage of the benefit from 1% to 2.5%. Is it within the control of the company or not within the control of the company? What do you think? Is it within the control or not within the control of the company? Is it within or not within the control of the company? It is within the control. It is within the control because company only can take this decision. Company can take this decision. Okay. So therefore, we are going to now recognize the increased obligation. 1 crore is your salary. 1.31 crore is your salary, including the annual increase that you have estimated. Cost of benefit on termination 2.5%. So that comes to 16,38,495. Okay, it is 16 lakh. As against how much I had recognized earlier? Sir, against this you had recognized earlier only 6,55,398. Now it is come to 16 lakhs. Now it is come to 16 lakhs. So let us do the attribution of benefits first. Let us do the attribution of benefits first. So therefore, this is the usual working. This is also the usual working. Yes. So that gives you your closing obligation. That gives you your closing obligation. Yes. So now, first year, has it changed in the first year? 2,23,823. Yes. 2,23,823 is the first year obligation. Second year obligation. Third, fourth, fifth. Yes. First, second, third, fourth, fifth. Now the question is, year one has passed. Year one, I did the accounting based on 1%. Year two, the management has changed it. The management has changed it. Yes. Year two, what am I having? Year two, the value was 1,96,964. Actually, the value should be 4,92,410. So the obligation should be 492,410. How much was your obligation? 196,964. 196,964. Are we clear with this? Yes. Have you understood this? Yes or no? Bolo. Year 2 के end में my obligation that is appearing in the books is 196,964 because they have already taken these entries. Now, year 2, the management has come out with a change. So therefore, the liability has increased to 4,92,000. Are these entries taken in the books? Answer is no. This is just a management calculation. Which entries are appearing in the books? 1,96,964. So therefore, 196 should be increased to 4,92,000. So that is an increase of 2,95,446. Acha, this increase is known as past service cost. This increase is known as past service cost. Yes, this is known as past service cost. All right. So now look at the presentation. How am I going to treat it? Employee benefit expense, interest account debit, past service cost account debit, credit provision for employee benefits. Credit provision for employee benefits. Are you clear with this? Yes, are you clear? So in year 2, employee benefits 98,482 will come. Interest 8,953. Past service cost 2,95,446. Total credit of 402,881. अच्छा, past service cost कहां पर जाएगा? It will go to the P&L. It will go to the P&L. Yes or no? Yes, because it is within the control of the entity, this will go and sit in the profit and loss account. Yes. All right. So that takes care of this. Next are all yes, done. Done. Past service cost is done. All right. So that is done. Okay. Next one. All right. Any doubts so far? No doubts. Yes. Okay. So now let us move on to the next part. Okay. Okay, just read this for homework. Gate settlement of plans. We will have a question maybe on this. Which discount rate to use? They are saying discounted to ultimate cost of benefit. Which discount rate to use? Because there are so many rates available. Okay. So general rule, we will use the market yields at the end of the reporting bond on government. Yes, the special rule is for currencies other than INR for which there is a deep market in high quality corporate bonds. Okay, so you have a general rule and you have a special rule, both of them. Okay, so typically we take the market yields. Okay, next one, fair value of plan assets. What are plan assets? See, typically we set aside some amount. We set aside some amount for the purpose of maintaining the what we say for the purpose of maintaining cash at the time of settlement. Tomorrow it should not happen that there is no cash when an employee has resigned or left or retired or superannuated. Okay, so therefore, if we have to create this, then where do I invest? How much do I invest? Is there any guidance by the standard? And answer says no. There is no guidance by the standard. Entire amount you can put it in fixed deposits. You can put it in low securities or low risk securities or gilt edged securities or mutual funds. Wherever you want, you can put. But yes, this time. The standard does not give a guidance for this, but the standard has given guidance for usage of an actuary. It would be ideal if an actuary is appointed. That is there in the standard. Okay. So now coming to plan assets. These are the assets where you are investing. Muhammad, the year increase in year one was not accounted because the increase has happened from year two. The increase has happened in year two. Year one, they did not decide. So, year two, they decided. Year two, I took the differential impact. Year three, four, and five will happen as per the fresh plan, as per the fresh plan. Is it okay? Yes. In year two, they took a call. That is what is given in the question. Okay. Now, the next one is, okay, so you are having one or two questions. All right, fine. Okay. Let me just see what is left to take you through. Okay. All right. Fine. Okay. Yeah. So these assets not mandatory. They could be fixed deposits. They could be low risk securities. They could be government securities. They could be market securities. They could be anything. Or you may choose not to invest if you are a cash rich company. If you are a cash rich company. But if you set aside plan assets, if you have a separate plan assets, then these assets will be earmarked for employee liability settlement only, and you cannot use it for any other what you can say, for any other purpose. You cannot use it. Okay, so that is what is plan assets. You will have to do the fair valuation of these plan assets at each reporting period. At each reporting period. Okay. All right. Any doubts? Any doubts? No doubts? Okay. So now coming to determine deficit or surplus, what exactly we mean deficit or surplus? We take the present value of defined obligation minus fair value of planned assets, minus the fair value of planned assets. If it is positive, that means your obligation is more, plan asset is less, it will be called as a net defined benefit obligations. Net defined benefit obligations. If the fair value of plan assets is high, then it will end up with the surplus. Yes, then it will be a surplus. Is it okay? Yes, surplus is an asset, deficit is a liability. All right. Next, next. Okay, go through this. This is not major important. Yes. So how do we report in the balance sheet? If the difference is positive, obligation minus asset. If it is positive, it is called as a deficit. It becomes net defined benefit liability. Entire deficit is recognized in balance sheet as provisions under non-current liability. Yes, so that is done. If the difference is negative, it is called surplus, it becomes an asset. We are recognizing it at least of asset ceiling or surplus as computed above. Okay, so that is how you will do the reporting. Nothing much to say in this regard. Okay, so just go through these 2-3 questions. These are very simple. Okay. Okay, so that takes care of that. Then we move on to the next one. How are you guys placed? We do some more, or you want to end, or you want to continue? How are you guys placed? Would you want to continue for another half an hour, 45 minutes? Or you want to end and continue on Tuesday? One is saying continue, one is saying bus karo sir, Sunday bhi mat pareshan karo. Yes, okay. I'll do just one or two small questions. I won't take much of your time because these small questions will help us on Tuesday. Okay. So coming to question 11, we spoke about plan assets. how do I determine the plan assets in the beginning? How do I determine the plan assets, return on plan assets during the year? Okay, so very simple. You make a small ledger account and get it done. Okay, so I'll show you how it is being done. Okay, all right. From the following information, compute the actual return on plan assets in respect of Vinayak Limited for the year ending March 2020. Benefits paid is 5 lakhs, employees contribution 7 lakhs, 28 lakh 50 year end, and 20 lakh is the opening balance. Okay, so very simple. This is 10th, 11th standard commerce. Balance brought down 20 lakhs, opening balance, closing balance 28 lakh 50. Benefits paid out of plan assets is 5 lakhs, and employer's contribution for the period is 7 lakhs, which is given to you. Why this employer contribution for the period comes here? Employer contribution increases. Employer contribution increases the available assets, and that is why it is debited there. So if I do this, then 6 lakh 50 is going to be a balancing figure. That balancing figure is known as earnings from that particular, what you can say, plan assets. Okay, earnings from those plan assets. All right. Or if you are not comfortable with a T form account, you can do it in the statement form also. You can do it in statement form also. Okay. So that one you can have a look. Yeah, done. All right. So that takes care of this illustration. Plan assets, deficit surplus is done. PV of defined obligations is done. I'm leaving you with these questions. We will take up recognition in the P&L in the next class. Okay. Where what will go, I have already explained to you. It goes and sits under employee benefit expenses. Even the related unwinding of discount goes and sits in the profit and loss account under employee benefit expenses only. Nothing else. Okay, so that is something you will have to look after on Tuesday. Okay, then we'll pick up the remaining questions on Tuesday. Most of it is there. Did you get do you have these notes with you? First of all, you answer this question. Do you have this set of notes? Do you have this set of notes? Do you have these notes? Some of them could be in the study material, some of them are not in the study material. Okay, so you can just have a look. Do you have these notes? It is there on the assignment section. Please check right now. Board of Studies assignment section, it should be there. Check on the assignment portal. Okay, downloading now. Good. So do this after the class, and I want you to do all the questions until question 11 from here. Okay. We will do question number 12, question 13 also you can try. I am leaving you with question 13. It is a change in actuarial assumption. Okay. So I want you to try this out yourself. Homework. Okay. All right. And then we will do the remaining questions and close it in a short while on Tuesday. Okay. So please download that, everyone, and confirm. Do up to 13 questions today. Okay. And was the session helpful? There were a lot of disturbances in between, but I suppose the continuity was not majorly affected, I hope. Yes? Are you able to follow whatever was discussed till now? Are you able to discuss whatever, are you able to follow whatever has been discussed till now? Yes? Okay. What about the others? If anybody has any difficulty, any suggestion, any improvement required, speed, hey, don't worry about the doubts. The doubts are never dumb, okay? The doubts, it's good to have lot of doubts here, okay? It's good to have lot of doubts in the class so that you are not dumb in the examination, okay? Any number of doubts are welcome. Your doubts keep us thinking, okay? Otherwise, it is a one-way street and we also end up getting bored, okay? So thanks, guys. See you all on Tuesday. Tuesday will be a small class. I should be winding up within 2.5 hours. So Tuesday will meet and catch up with each other and close the stand. Okay. Thanks. Thank you guys. See you on